rules. Money rules. Money. Welcome to the Money Rules podcast, where we tackle your personal financial matters with leading financial advisors. Your host, Boitumelo Ntsoko.
Today we're tackling a topic that has long been debated among economists, advisors and actuaries: sustainable income from living annuities. With ever-changing market dynamics and economic conditions, balancing drawing income and preserving capital is more crucial than ever. Marius Fenwick, a certified financial planner at WealthUp, joins us today to discuss navigating these challenges. Welcome, Marius.
Jimmy, thank you so much. Thank you for having me.
Before we start, please don't forget to follow us on Spotify and Apple Podcasts, share this podcast with your friends, and download our episodes for easy listening on the go. Marius, the discussion about sustainable income from living annuities has evolved significantly over the years. Could you start by giving us a brief overview of how market dynamics have influenced this debate?
Sure. To me, if you look about a decade ago, I think it was accepted that one can draw 6% income and that it's sustainable over a long period from living annuities. Today, that figure is, I think, accepted globally to be around about 4%. And I think the main drivers for that is that markets are more volatile. I think inflation is a big factor that one's got to consider. Inflation is more difficult to determine, and I think each individual has his own inflation, and a lot of that is driven by medical inflation. So the more you rely on medical expenses, the larger your annual escalation is going to be. And I think escalation is a bigger driver of capital depletion of living annuities than what the drawdown itself is. One can draw 4, 5, or 6%. Doesn't matter by how much it's got to escalate every year, and which I'll cover a bit later on. That will actually determine the sustainability of the portfolio. In South Africa, we have additional complication, if you want to call it a complication. It's the complexity of offshore exposure within a living annuity. Currency volatility brings in more challenges in terms of the sequence of returns of the portfolio, which ultimately also determines the sustainability of it. So in South Africa, we do have a bit of more of a complication, as because we do tend to be a bit more offshore biased than developed markets.
Marius, you mentioned that globally the drawdown rate that's advised is 4%. Does that apply to South Africa as well?
No, absolutely. If we can run the figures, if you see that especially over the last decade, South African markets, and I think funds broadly, in the low equity space, in the medium equity space, and high equity space, have actually disappointed. So, some of those figures run around the 6% return per year, if you're lucky, 8% per year. But it comes back to, as I mentioned earlier on, it all depends at how much you want to escalate it, on an annual basis. So if we rely on inflationary increases, in other words, if we want to maintain our living annuity income at a real level, then 4% absolutely. And if you want to rely purely on a drawdown rate, in other words, you want to retain just your nominal level and just draw the amount of return that you get, then it's fine. Then 6% is fine, but 4% most certainly is a figure that I think that's globally accepted, including in South Africa.
And what are the main factors contributing to the risk of capital depletion in living annuities?
So I think the first and foremost is not beating inflation. And once again, we get back to the escalation. I seem to be hammering on the annual escalations. But if we can't beat inflation, then we can't escalate, and we can't keep our income in line with inflation. So inflation, number one, as far as I'm concerned. Drawing too much income. We know that in South Africa in particular, people don't save enough, and that forces them to draw higher than the required or the suggested 4 or 6%. And, it's not unusual seeing drawdowns of 8, 9, 10, 11, even 12 and higher percentages. So that's most certainly a portfolio killer. Investing too conservatively. In order to beat inflation, one's got to take exposure to growth assets. So a conservative investment that doesn't have sufficient exposure to not just to the growth assets, but also to global portfolio, to global assets. That's most certainly a factor that can influence that. And I think investor behavior. We find that we investors aren't advised. It's a problem because they tend to get in and out of markets at exactly the wrong time. So investor behavior can be a tricky one as well. And then the sequence of returns. If you look at the start of a living annuity, it's more important than once it's been running for a couple of years. But the sequence of returns, if you experience a year or two, and most certainly if it's more than 2 years of negative returns at the start of a living annuity, that tends to hurt it in a manner that it can't recover. And just by way of example, to give you a bit of a brief on that, I mean, if you've got a portfolio and let's say it's worth, excuse me, 100 Rand, and the portfolio pulls back or the market pulls back 20%, it gives you 80. You mustn't make back just 20% on that 80, because you make back just 20%, it takes you back to 96. So you've got to make back 25% to get you back to the 100. Then you've got to add your drawdown. So if you're drawing down 5%, it means you've got to have a return of 30%. So a 20% drawdown in the market results in a forced recovery of 30% just to break even. So the sequence of returns is an important one, and then there are ways to try and counter that. So I think those in my mind are probably the main factors that do contribute and that are a risk for capital depletion.
Marius, given some of the challenges that you have mentioned, what can investors do to reduce this risk?
To me, I think when we talk with clients and we do portfolio structuring, we have a conversation around what's the appropriate returns that you require for a portfolio, not the maximum returns. As soon as you start aiming for maximum returns, you tend to take on undue and unnecessary risks and go too aggressive in a portfolio. And then we get back to that sequence of returns. You don't want volatility in a portfolio, so we want to try and limit that volatility. So aim for appropriate returns. Structure the portfolio to limit that volatility. If the markets do go down or there's some bad news, don't disinvest. That's also a portfolio killer. There's a lot of research to show the impact of trying to time the market and get in and out of the market at certain times, and people don't get it right, and the loss in that is huge. And beware of too much offshore exposure. There's a lot's been said about having offshore exposure in the portfolio, and I mean, I've written about it in the past as well. One must be mindful that even though we're very pro offshore investment, too much offshore investment can actually hurt you, especially if you're drawing a higher level of income. So if you're drawing, for instance, 5% or less, I mean, you don't have to worry about a maximum. You can invest as much as you want offshore while you're drawing against the portfolio. If it starts moving toward that 8% drawdown, I generally suggest don't have more than 50% offshore exposure. And if your income is drawn at 12% or more, then I say probably 25% is a maximum. And the reason for that is it comes back to that sequence of returns. With offshore exposure, you've got rand volatility, and with that comes much, much, much more volatility in as well. As the rand not so much weakens, or the rand weakens, it counts in your favor. But this is one case where the rand works against you, is when it strengthens. And people tend to get into the frame of mind that when the rand is weakening, it's on a slide, it's never going to recover, and they tend to go much more aggressive offshore, once again at the wrong times. When that rand turns around, starts strengthening, like we've seen now again. I mean, we were over 19 rand, we're sitting sub 18. In COVID, at one stage, we were over 19 rand to the dollar. It went all the way down to 13 rand 50. We only hit, well, we're not even at 19 now again. And we tend to see people take money aggressively offshore when the rand's at its weakest, and that's absolutely the wrong time you should do it. So I just got to be mindful. Offshore exposure, very important to have, but limit that. And then what else can one do? One can create an income pot. I like to take probably 2 to 3 years of income, put it in a cash portfolio, and then only pay the client out of the cash portfolio. In other words, then even though that doesn't mean your portfolio can't go negative, but at least it takes out that your mind on the portfolio the whole time. That's there's a negative market and that's impacting your portfolio. At least then you know the portion that you're getting your income from is secure. And generally, if it's in a multi-asset fund, it's highly unlikely that it's going to be negative for 3 years. So there should be sufficient growth to top up that income pot again within the next 3 years. And then I think lastly is, given where annuity rates are at the moment, it's not a bad idea to include a life annuity as part of your solution. Life annuities at the moment, especially without escalations, are giving you 12-13% yield. So, if you can get that into your income solution, then you can drop your living annuity all the way down to 2.5%.
Marius, you mentioned quite a few times the risk of inflation, and it seems like achieving inflation-beating returns is key. How can investors go about this, especially considering the need to balance between growth and safety?
Yeah, it's I mentioned earlier on looking at appropriate returns, but I think even the looking at appropriate return is to have enough growth assets in your portfolio. And even though it sounded like I spoke slightly negative on the offshore side, to have sufficient offshore exposure in your portfolio as well. Those are the two drivers for SA assets. But just once again on the offshore side, just be careful. I mean, if things carry on the way as they are at the moment politically in South Africa, and our infrastructure improves, we see Eskom improve, and if the same happens to the railways and to the ports, I mean, the rand can go to 17 rand and sub 17. If it stays there, once again, just be mindful of the offshore amount, but it's important to have that. So enough growth assets, separate the income pot and the growth pot, as I mentioned early on. I mentioned the life annuity. And then another strategy that we look at, but then investors need some discretionary money as well, is to reduce your tax rate. So obviously the lower taxes you pay, the less gross drawdown you have to do to get your required net income. And the way we do that is to draw a fair amount from your voluntary investments and rather pay capital gains tax than income tax. So if you can reduce your tax, then your total drawdown on your overall portfolio comes down as well. And then if you're on that note of using voluntary funds to subsidize your income, if you are drawing from your voluntary funds and the percentage that you're drawing from your living annuities at the minimum, let's say it's a 2.5% minimum requirement, and you still have too much capital, then we introduce what we call a looping structure. I wrote about that as well, where you then take a contribution, stick it into an RA, get that tax neutral, and at the end of that year, you just retire from the RA and go straight back into your living annuity again. So you just loop from the one to the other. And done efficiently, you can bring down your tax rate substantially. I mean, you can get it from the 30% down to single figures if one does it properly. But then people do need voluntary funds as well. And it's normally around about I normally suggest people should look at least a 50-50 split, 50% compulsory money, 50% voluntary money. Then you can get that structure very efficient and sorted out.
You mentioned creating an income pot quite a few times. Can you give us some insights into how this is done? And is it done by the advisors, or would it be something that I would have to request?
So the idea is to basically inside your living annuity, it's just because you can nominate once you set up your annuity, you can nominate where the capital or where the funds, your monthly income can be paid from. So you can set up your investment in such a manner that a portion is structured as a growth component and the other one as an income component. And you can nominate the income to pay out of that income component. So let's keep it simple and not include income funds, whatever. Let's just call it a normal money market fund. So you can take, as I mentioned earlier on, between 2 and 3 years of income. And normally, the lower the percentage that you're drawing, the more multiple years you can keep. So if you're drawing 2.5%, it makes sense to keep 3 years income because that's only 7.5% of the portfolio. But if you're drawing 10%, it means you've got to put in 30%, which is going to have an impact on the growth component side, and you might not meet your target. So let's keep it simple. Say a person's drawing like 5% or whatever. Stick between 2 and 3 years income in a money market and instruct the administrator to pay only out of that money market. So that will come down over a period of 3 years and 3 months or 3.5 years. That pot will be depleted. But the idea is then to regularly, you don't have to wait until the end. So if your growth component of your investment has decent growth, one can actually go and harvest some of the profits from that and stick it back into the as we refer to as the income pot. And the idea is then to keep that replenished the whole time. It might be that it runs down to only 6 months of income left in the pot before you top it up. But that at least gives you that flexibility to give the growth side to draw, to grow and not draw against it. Plus, as I mentioned early on, it just gives you that peace of mind that the component that I'm drawing my income from is not going to deplete or is not going to fluctuate. So it's a bit of a mindset, but it works. And I like the principle. Some fund managers and analysts don't believe in the strategy. They believe that just draw equal from all funds. I think once you go through volatile times and low return times, the figures do show that it makes sense and it does work. So that's basically a strategy that we introduce and offer the clients.
Marius, just as we wrap up, do you have any final advice for our listeners regarding managing their living annuity income and their retirement planning in general?
I think the first thing that I want to tell retirees, and it's a tough message to receive, is don't give away money too soon. We as parents always want to give the best to our children, so that we find so often that investors and retirees give away money too soon. I always tell people, your children must be patient. They'll inherit the day that you're no longer there. So don't impede your lifestyle and your living conditions to try and help. Budget, plan future expenses, and discuss your financial position with your family and children in particular. We find that quite often children and spouses, for that matter, have the wrong impression of the financial position that the main member of the family is in. They might think that 5 million rands are a lot of money if they do know how much he's got. And depending on the income drawn, it might not be sufficient. And if you in any way believe that you are going to fall short or run out of capital sometime in the future, tell your family sooner rather than later. I have yet to find a family where children won't help and assist, but they need time to plan and prepare for it. Don't dump it on the last minute. Just getting back to the capital, for a 25,000 rand a month, and you want your capital to last for 20 years, you need 5 million rand. To have that sustainable income. If you want the capital to last for 30 years, that 25,000 rand a month, you need 6 million rand at least. And I think those are the kind of things that retirees should discuss with their families, just so that everybody's on the same page and that they don't get the false impression of the financial position. And then I think, and I alluded to it earlier on, given the current high annuity rates that one can get at the moment, I would strongly suggest that people at least investigate it and see, how that can impact them. Over the last 12, 18 months, we've done quite a fair amount of conversions from living annuities to life annuities. It just made so much more financial sense. Don't gamble with your money and avoid schemes. Unfortunately, we often find retirees being the targets of all kinds of funny pyramid schemes and Ponzi schemes and funny things out there. If it sounds too good, it probably is. Rather stick to the mundane, simple things. Don't try and get involved in, the strange thing, including crypto, for that matter. And to find a solid financial advisor with references to help you and guide you. The older you get, the more difficult it gets in retirement. One does go through health ailments and memory loss and things do become part of it. So try, get your advisory and support team in place before it's too late, and walk the path with them and grow with them. Retirement and financial planning is much more than just putting portfolios together. There's a lot of other supporting functions that goes with it.
All right. Thank you, Marius, for joining us on this episode and sharing these valuable insights with us.
Thank you. Thanks for having me, Tony.
That was Marius Fenwick, a certified financial planner at Wealth Up.
Thanks for listening to this episode of the Money Rules Podcast. To listen to more, go to moneyweb.co.za or the Moneyweb app and follow Moneyweb News for daily updates. insights. Moneyweb, your trusted source for business and investment insights.